Let's talk to Chris Justham. He's an investment manager at 7IM. Very good morning to you.
Good to see you, mate.
Long time no see.
Quiet.
Right, a statistic for you. I read in the last 24 hours in excess of 80% of people thought we were in the ninth innings, and circa 38% of people were thinking we were going into recession next year.
So I love the cricket analogy, and I think it's a good one, particularly when you're talking to clients. We go out and speak to retail clients all the time.
Yep.
And you need to be able to explain to them how we see the world. It's a great one. However, what I don't really subscribe to is the fact that people are saying, doom is round the corner. I mean, when people extrapolate recent market volatility and, for example, what's going on with Brexit, and they say that means there's going to be a recession, it's too simplistic. And you're trying to attribute a narrative where the data doesn't really back it up. So that's not something that we particularly agree with at the moment. We're not saying that a recession won't happen because, you know, as I mentioned, the getting down to your tail end of your batting order, for example, is a great one. But we don't think it's going to happen tomorrow, no.
Okay, so we spoke earlier in the year and we were talking about the FTSE 100 being in a trading range of 7,000 to 7,700, sell it at 7,700, buy it at 7,000. Would you be a buyer at this level? Is this an opportunity of a lifetime? We've had a decent pullback, okay. Would you go fully loaded?
We, at the moment, still hold a slight underweight towards the FTSE 100. We have increased our allocation to there throughout the year. Obviously, it looks slightly cheaper than it does even a few weeks ago, certainly. So there would be opportunities. I think the banking sector in particular has still got some headroom. At the same time, you can't ignore the political situation. And despite the fact that it is a global index and it should reflect more what's going on with regards to global trade, obviously that's another part I'm sure we'll get onto in a moment, it still has a very, very clear link with what's going on with sterling. It still has a very, very clear link with how people feel towards the UK. And that's even taken into account the fact that 80% of the earnings come from abroad. So in short answer to your question, we have increased our allocation towards the UK, but we're not going gung-ho in that specific area because you cannot ignore the whole Brexit.
So if I was trading the London stock markets, okay, should I actually be a currency trader at this point in time and just purely trade on the back of what sterling is doing?
It's incredibly difficult to understand what sterling's doing. And again, people try and attribute narratives to it after an event. So Theresa May makes a speech, sterling moves. And what does my head in is when you look at a news outlet, let's just say, and they say sterling plummets as a result of Theresa May's speech. You look at the axis, and then you actually see it's only moved by a few basis points. We're not talking huge moves. So that's my personal frustration aside, but it's incredibly difficult to understand or to say sterling is going to do one through another because it's continually wrong for its people. However, you have to take it into consideration when you're investing. So, I mean, I wouldn't want personally to be a currency trader at the moment because I think it's an incredibly difficult job. But when you're investing in portfolios, if you're going to take global exposure, you cannot ignore it. And with Brexit, for us, that is the point of potential pain or potential upside for people that is going to have a bigger impact than maybe a UK equity allocation. Because if you take an exposure abroad, let's just say to emerging markets or Latin America or Europe or the US, you have currency exposure. People ignore that. If you choose to go completely unhedged, then effectively you're chucking caution into the wind and you're just going to wait and see what happens. You have to have a position and insulate yourself against movement one way or another.
Okay, so the technical analysis is suggesting that the equity markets are teetering. That's their words, not mine. I've seen gold rallying. I'm seeing headlines oil to $100. I'm seeing the Italian government bonds in a pickle. Are we just basically going through a phase, a bull market, wall of worry, okay? Is this a real wall of worry or is this just something we're going to get through as we always do?
I think our desire for short-term data, so great example, we are more interested now in Donald Trump's Twitter account and some of his phrases as opposed to his policies. We are much more interested in T20, using your cricket analogy, than we are the long game. We want information and we want it now. And I think when you see equity market fluctuations, last year, 2017, artificially benign, 8 moves of more than 1% of S&P. This year we've had 40. And all of a sudden people are panicking. The long-term average is 50 if you look over the last 40 years. This is normal. This is equity markets doing what equity markets do. So when you have bouts of volatility like this, we think it's just equity markets moving as they will. You can say it's to do with steepening trajectory of interest rates in the US. You can say it's to do with trade. You can put any number of factors to it and tell a story. But ultimately, this is just short-term fluctuations. And this is why when people invest, they need to make sure they have eggs in baskets and not go gung-ho and too concentrated into any one area. Americas, this is what will happen. So no, we don't think that, as I mentioned at the beginning, this is a portent of doom, this is a harbinger of something more serious as it stands at the moment. You have to remain vigilant in periods of volatility. But for us, we still like the fact that the global economy looks solid. A lot of the macro data would still support that, and that's what we have to hang our hat on.
Okay, so you talked about eggs in baskets. What baskets would you favour at the moment in terms of sectors?
So in terms of, as you know, we're asset allocation as a house. That's the name of the game for us. So we won't look for bottom up, we look top down. So as a headline, we like equities. We don't like equities so much that we're going to go highly concentrate into certain areas. I think you could pretty much divide a room at the moment as to those who have been highly concentrated in the US this year and the rest. So we're small overweight in the US. We are small overweight in Europe, small overweight in Japan, small underweight UK, but as I mentioned, we have increased allocation this year. So equities, we're broadly okay on. We're sanguine about the global outlook. What we don't like is bonds. And when I say bonds, obviously sweeping generalisation, but if you look at a lot of traditional portfolios, the lifestyling style investments that people have got, as they get older, they load up on bonds. When interest rates go up, a lot of these people are going to be feeling pain, and everybody is ignoring that. We've had a bull market of 35 years on some of these developed market bonds, and the maths you cannot escape from. A 1% interest rate rise on a 10-year bond potentially means 5 to 10% fall on the underlying capital value of that bond. You can't escape it. So we don't particularly like that area. Alternatives, we've done a lot in. You've met Matthew on a number of occasions. You've come on and spoken in that area. We've had to work incredibly hard to look at other areas of diversification. Because if you don't want to go too highly overweight into equity and you're going to remain neutral, but you don't like bonds, that's the traditional area you'll diversify into. You've got to look elsewhere. So some commodities, we've got some private equity. We have some infrastructure investments, and we have other equity market neutral strategies.
Any cryptocurrency in there?
No, not for us. Not for us.
Is that your decision?
No, I'm not important enough for that. No, I mean, it's interesting for me how quiet a lot of the cryptocurrency people have become over the course of the last 6 to 9 months. Had a hell of a run, and I think people did phenomenally well out of it. But for us, as it stands at the moment, blockchain's interesting. I think that's not going to go away. But cryptocurrencies and all of these initial coin offerings and everything else, no, that's not our game.
I'm delighted that I'm on your side of the fence now. On that note, Chris, thank you very much indeed for your time.